You know what's interesting? Most people can tell you exactly how much their favorite coffee costs. They know the price of the new iPhone. They know what their Netflix subscription jumped to last month. But ask them how much they actually kept last year, after taxes, after rent, after all the subscriptions they forgot to cancel, and they go quiet. Not because they're bad with money, but because nobody ever really showed them how money actually works in real life. Today, that changes. This isn't a video about getting rich. It's about something more useful than that. It's about never being financially broken again.
Let's start with someone very real. Meet Daniel. He's 27. He lives in Chicago. He just landed a job that pays $58,000 a year. His family's proud. His friends think he's doing great. He goes out to dinner to celebrate. And for a few weeks, he actually feels financially stable. Then the paychecks start arriving. And this is where reality quietly walks into the room. $58,000 a year sounds like $4,833 a month. But Daniel lives in Illinois. After federal income tax, state tax, Social Security, and Medicare, he takes home somewhere around $3,650 a month. That's not a complaint, that's just arithmetic. $3,650. That's what Daniel actually has to work with, not $4,833, not $58,000. Now, the average one-bedroom apartment in Chicago right now is running around $1,750 to $1,900 a month. Let's say Daniel found something decent for $1,800. That leaves him $1,850. He has a car payment, nothing fancy, a used Honda Civic he financed, $320 a month. Insurance on top of that, $140. Now he has $1,390. Student loans. He studied business, graduated with $34,000 in federal loans. Standard repayment plan, roughly $340 a month. Now he has $1,050 left for the entire month. Food, utilities, phone, internet, clothing, emergencies, social life, everything. $1,050. And here's the thing. Daniel isn't irresponsible. He didn't buy a boat. He didn't go to Vegas. He made completely average, completely normal life choices. And he has $1,000 left to live on. This is the illusion of a good salary. The number on your offer letter and the number you actually live on, they're two very different numbers. And most people never do this math before they sign the lease, before they finance the car, before they agree to the loan terms. They do the math after, when it's already too late to adjust.
Now, if you're watching from Europe, you might be thinking, okay, but we have better social systems, free healthcare, cheaper university in many countries. And that's true. But the trap looks slightly different there. It doesn't disappear. Take Leah. She's 29. She works in marketing in Lyon, France. Her gross salary is 36,000 euros a year, which is genuinely not bad for her region. After French income tax and social contributions, which are notably higher than in the US but come with healthcare and other benefits, she takes home roughly 2,100 to 2,200 euros per month. A modest one-bedroom apartment in Lyon, around 750 to 900 euros. Let's call it 820. She doesn't have a car, she uses public transit. That's 70 euros a month. She has no student debt because France, good. But she does have a phone contract, a streaming service or two, a gym membership she goes to sometimes, and groceries. By the time the basics are handled, Leah also has somewhere between 900 and 1,000 euros left. The number is similar. The pressure is similar. And in both cases, in Chicago and in Lyon, there is almost no margin, no cushion, no buffer, no room for something unexpected. This is not a pessimistic observation. This is the starting point, because once you understand the actual terrain, you can start navigating it properly.
There are three categories of spending that, when they go slightly wrong, make everything else impossible to fix: housing, transportation, debt. These are what financial planners sometimes call fixed costs, and that name is important because they are fixed. You can't skip rent for a month because you had a rough week. You can't pause your car payment because you wanted to travel. These numbers show up every single month, whether you had a good month or not. And most people, without realizing it, let these three categories consume too much. The older rule of thumb said housing should be no more than 30% of your gross income. That rule was written in the 1980s. It's still quoted, it's almost useless now in expensive cities, but it gives us a starting reference. Let's use Daniel again. His gross monthly income is about $4,833. 30% of that is $1,450. His rent is $1,800. He's already over before anything else is even counted. Now, can Daniel find a cheaper apartment? Maybe, or maybe not, depending on the city, the commute, the safety of the neighborhood. These aren't always choices. Sometimes the market is what it is. But this is the point. When your fixed costs are too high relative to your real income, you don't have a spending problem. You have a structure problem. And you can't solve a structure problem by making coffee at home. This is something that just cut the avocado toast crowd misses entirely. If your rent, your car, and your debt repayments together take more than 55 to 60% of your take-home pay, nothing else you do financially will matter very much. The math won't allow it. The only levers that change the structure are earning more, spending less on the fixed categories, which sometimes means moving, changing cars, or aggressively addressing debt, or both. Everything else is noise.
Let's talk about credit cards. Not in a scary way, in a math way, because the math is where the real story is. The average American carries a credit card balance of around $6,000 to $7,000. The average interest rate on that balance right now, as of the mid-2020s, is somewhere between 20% and 24% annually. Let's use $6,000 at 21% APR. If you make only the minimum payment each month, which is designed to be just small enough to feel manageable, you will spend years paying that off. On a $6,000 balance at 21%, making minimum payments, you could easily be looking at 15 to 17 years to clear it, and you will pay somewhere between $7,000 and $9,000 in interest alone. You borrowed $6,000. You'll pay back $13,000 to $15,000 total. That's not a credit card. That's a subscription to financial instability. And here's why people don't feel this happening. Because $6,000 wasn't spent in one day. It was built slowly. A flight here, a repair there, a month where groceries and a birthday dinner and a car insurance renewal all landed at once. The credit card didn't feel like a choice. It felt like a solution. And that's exactly how it's designed to feel. The psychological mechanism here is called pain of paying. When you hand over cash or watch your bank balance drop, there's a small but real emotional discomfort. That friction makes you slightly more thoughtful. When you tap a card, especially a credit card, that friction almost disappears. The spending feels abstract. The consequence is delayed by 30 days. And by then, you've already had the coffee or the dinner or the flight. This isn't a moral failure. It's a design feature of the product. Credit cards are engineered, very thoughtfully engineered, to reduce spending friction while maximizing the chance you'll carry a balance. Knowing that doesn't make you immune to it, but it changes how you hold the card.
There's a force in modern life that nobody puts on a budget spreadsheet, but it might be the most powerful financial force most people experience. It doesn't have a line item. It has a name, though: social comparison. In previous generations, you compared yourself to your neighbors, your colleagues, your family. That was the reference group. It was limited. It was local. Now, your reference group is global, curated, and relentless. You're not just comparing yourself to your coworker who got a raise, you're unconsciously measuring your life against people with perfectly lit apartments in Lisbon, weekend trips to Copenhagen, and kitchens that look like architecture magazines. And most of those people are either significantly wealthier than you, in significant debt, or being paid to look that way. Sometimes all three. The result is a very quiet but very persistent pressure to upgrade. Not from $500 rent to $1,800 all at once, from $1,800 rent to $2,100 because you got a small raise and the nicer apartment felt deserved. From a used car to a leased car because the financing was easy. From cooking 5 nights a week to 3 nights a week because you're tired and delivery is right there on your phone. Each upgrade is small. Each upgrade feels reasonable in the moment. But together, they do something called lifestyle inflation, and it is the primary reason that people who earn more don't automatically become more financially stable. Here's a number that illustrates this clearly. In the United States, studies consistently show that a significant portion of people earning over $100,000 a year still live paycheck to paycheck. Not because $100,000 isn't a lot of money, it is, but because lifestyle expansion tends to rise with income, and sometimes faster than income. The solution isn't deprivation, it's intentionality. It's the difference between choosing your lifestyle and drifting into one.
Let's shift. Because this video isn't about cataloging problems, it's about understanding a different way of thinking, a quieter way, one that doesn't show up on social media very much because it isn't dramatic. People who are genuinely financially stable, not rich, not perfect, just stable, tend to share a few ways of looking at money that are different from the default. The first one is this. They think in monthly structures, not monthly balances. What I mean is, they don't just check how much is in their account. They know exactly what their fixed costs are, what their real take-home is, and therefore what their actual discretionary income is, every month. That number, real take-home minus fixed costs, is the number that matters. Everything else comes out of that, and they know it before the month starts, not after. This sounds simple, almost obvious, but most people don't do it. Most people have a rough sense of their balance and a vague feeling about whether they're doing okay. Feelings are not a financial strategy. The second shift is how they think about debt. They don't think of debt as a number. They think of it as a monthly obligation competing with their freedom. Every $300 in monthly debt payments is $300 that cannot become savings, cannot become investments, cannot become a financial buffer. It is already spoken for every single month, regardless of what else happens in your life. So they treat debt elimination not as a moral imperative, not because debt is shameful, but as a practical move to reclaim monthly income for themselves. When Daniel finishes paying off his student loan, he doesn't get a trophy, but he does get $340 a month back, every month, for the rest of his life until he takes on new debt. That's meaningful. That's real. The third shift, and this one is subtle, is how they respond to income increases. When most people get a raise, the lifestyle adjusts upward almost automatically. It's almost reflexive. A raise of $400 a month feels like permission to spend $400 more a month. Financially stable people, not all of them and not perfectly, but as a pattern, tend to pause before that reflex kicks in. They ask a simple question: what is the most useful thing this additional income can do? Sometimes the answer is pay off the credit card faster. Sometimes it's build up 3 months of expenses as a buffer. Sometimes it's finally start contributing to a retirement account or an ISA. The lifestyle upgrade may still come, but it comes after the structure is solid, not before. And that sequence, boring as it sounds, is what separates people who feel financially stable from people who feel financially anxious at the same income level.
Let's run 2 versions of the next 10 years. Same starting point, same income. Daniel, 27 years old, $3,650 take-home per month. Version 1. Daniel keeps his $1,800 apartment. He carries the credit card balance. He makes minimum payments on his loans. He gets a couple of small raises over 10 years, and his lifestyle expands with each one. He's not reckless. He eats out a reasonable amount. He travels occasionally. He buys normal things. He feels mostly okay, just a little stretched. At 37, his income has grown. Maybe he's taking home $5,200 a month now, but his rent is $2,300. He upgraded his car. He has a credit card balance he cycles through. He has a savings account with about $4,000 in it, which he dips into periodically for emergencies. He's not in crisis, but he has very little cushion, and he has very little freedom. A job loss, a health issue, an unexpected repair, any of those things is a financial emergency. Version 2. Same Daniel, same income. He finds a roommate for the first 2 years, drops his housing cost to $1,000. He aggressively pays down the credit card. It takes 14 months, but he clears it. He redirects that payment to his student loan and finishes it in year 4 instead of year 10. He starts contributing to a 401k, even just 6%, enough to get his employer match. He doesn't touch it. By the time he's 37, his income has grown the same amount, but he has no consumer debt. He has a financial buffer. He has retirement contributions that have been compounding for a decade, and his fixed costs are a smaller percentage of his income because he resisted the pressure to inflate them as fast as his raises came. He hasn't sacrificed everything. He's just made slightly different structural choices earlier. The gap between those two versions isn't income, it isn't intelligence, it isn't luck. It's structure, and a few decisions made when they were still easy to make.
So here's where we land. Financial stability isn't a personality type. It's not reserved for people who are naturally disciplined, or people who grew up with money, or people who found the right investment at the right time. It's the result of understanding the actual numbers in your actual life and making structural decisions based on those numbers rather than on social pressure, habit, or the feeling that you deserve a certain lifestyle right now. You might deserve it. That's not the question. The question is whether your financial structure can support it without quietly pulling everything else apart. That's the thing worth knowing. If this kind of calm, honest look at money is what you're looking for, not hype, not shortcuts, just clear thinking, then subscribing makes sense. We put out videos like this regularly. And if this one was useful to you, sharing it with someone who's just starting out, a younger sibling, a friend who just got their first real job, that's probably the most useful thing you could do with it. Take care of your structure. Everything else tends to follow.